Good afternoon, Dan.
Hey Rick, what's going on?
Oh, not a lot. Just watching this market continue on its trek upward. I want to welcome everybody to the Quarterly Conversations third quarter. And myself, Rick Bell, and Dan Brady, we are going to go through a good handful of information today to discuss what's going on in the market, what has been going on in the market in the last quarter, and a little bit more about what to expect in the future, and really what drives what we're talking about as we walk through our slide presentation here. Just a quick brief overview of the market conditions right now. Year to date, we are up about 22%, ending the quarter. And we are, that's on the S&P, and on the U.S. bond aggregate, we're up about 4.45. Most of that came about on the U.S. bond aggregate. About 5% of it came in the last quarter, and the S&P 500 was up about 5.9% in the last quarter. So we're continuing to move forward. I think this quarter, so this month so far, we're up about 2%, Dan. So I want to pass over to you so you can start off on your presentation.
Yeah, no, I mean that was a good segue right into this. I think not certainly not surprising on the bond side. We'll talk obviously a little bit about the Fed today, as we typically do, and some clear news in the third quarter with interest rates moving down. Not surprising that the bond market returns have been all thus far this year in the third quarter. I think one of the things certainly heading into this year that it is an election year. Talk about that too. One of the things that we certainly did not see coming is U.S. large cap measured by the S&P up over 22% year to date. Which if this can continue, that'll be back-to-back years that you have an S&P up over 20%, which is I don't have the statistics, but that is not typical that you have back-to-back years of 20% plus.
I'll take it.
Another thing, again, with the dollar weakening that we have seen is, again, compared to U.S. S&P 500 is still reigning supreme. But another thing that we certainly didn't see was emerging markets up about 17% year to date, with much of those returns coming in the third quarter as the U.S. dollar weakens. So something to look out for as interest rate policy is certainly changing. And we'll talk a little bit later about how some of these things are changing course from what we've seen recently. So a little bit about the outlook in the markets. It does appear that inflation has peaked. Now, I am not going to say that the war on inflation has been won. And in fact, as we talk a little more about this year's election, I do think there's a good case to be made that there's a lot of no matter what side of the fence you're on, there's a lot of inflationary policies out there. How that actually ends up bleeding into the markets and economy is a conversation for another day. But at least for now, it appears the inflation issue is in the rearview mirror. We just talked about the S&P 500. Earnings growth has continued to impress, and the AI trade appears to still be relevant and growing. We've talked about the broadening out of returns, which we've seen thus far in the third quarter, and we'll talk about that a little bit later. That's opportunities outside of large cap. And core bonds, with interest rates moving down, certainly look attractive. We'll talk a little bit. We do still think that the short-term bonds, that trade is not something that we want to abandon just yet, and we'll talk a little bit about why. And I talked a little bit about emerging market stocks and how a weakening dollar has been a tailwind for those. And interestingly, international seems to have done fairly well this year, although again, compared to US, still not quite as well. So that seems to be a continuing theme. And we've said this for quite a while. We said it coming into this year. Like I said, we certainly were not expecting the 22% return. Low to mid single digit annual returns over the next 5 years in US stocks. That's still our base case. That's sort of what we're expecting. Economy in good shape. Real adjusted for inflation GDP growth Q2 was 3%. The current estimate for Q3 is about 2.5%. So still strong numbers in economic growth. We'll talk about a soft landing. As of right now, no reason to believe that there's going to be a crash landing or a hard recession. I think in the next couple of slides, we'll talk about economic and business cycles. There's always contractionary periods. The question is whether or not those contractionary periods lead to really, severe or mild recessions. As of right now, there's no reason to suspect that, as economic growth is remaining generally healthy. But Rick, I'll let you talk a little bit about this because I know you like bringing up this chart.
Yeah, I'm a big fan of the business cycle, but we don't talk about the business cycle enough. We tend to talk about what the Federal Reserve is doing. And as Dan continues to go through a lot of these slides, we'll continue to talk about what the Federal Reserve is doing. But when we talk about what the Federal Reserve is doing, when we talk about indicators, when we talk about the economic calendar, or when Dan just talked about GDP, everything travels and revolves along this business cycle. That's that blue line that's going up to peak, down to recession, up through recovery and expansion. That's the business cycle. And the business cycle goes in that cycle all the time. And the market tends to follow that. That's that red dash line. We can roll into a bear market as we go from a peak to a recessionary period. And then we can turn around in a trough and roll right back into a bull market. It doesn't necessarily look like that all the time, and it's not that predictive, but this is what tends to happen. And as the Fed continues to focus on their 2% inflation, that black dashed line that's going right through the center of those two peaks and valleys, that's basically inflation right there, and that shows growth in the market. So the Federal Reserve is always looking to get that 2% of growth in the market, and that's what they're always going to continue to focus on. Now, in past news reports we've had recently, or over the past couple of years, they've been talking about, well, maybe the Fed should raise that to 3%, or maybe they should raise it to 3.5%. This inflation is going to continue on. That's not the ultimate goal. The goal still is 2%, and you want to keep that as even as possible to that 2% rate. So as we move through that business cycle from expansion to peak, that's when you start getting that inflationary time frame, when things are moving a little bit too fast. It's going up that business cycle a little bit too fast, and the Federal Reserve starts to come in and starts to tap on interest rates a little bit. So they'll increase Fed funds rates to try to slow things down a little bit, so it doesn't go too high too fast. As we roll over that peak, then we can roll into a recession where the Fed then starts to reduce interest rates to try to reduce the level of recession that we tend to have. And then we roll right back into expansion again. And the Federal Reserve is constantly touching on that to try to smooth out those peaks and valleys. Go on to the next one, Dan. I think that explains a little bit more.
Yeah, I think
unless you have something to add to that. Yeah, go ahead.
Just to point out, and this is obviously not, this is more art than science, I suppose. But
Definitely.
um, the the recessions, right? Economic recessions are really only declared in the rearview mirror. Um, right. So it's not like the Fed comes out and says, this is a recession. It's starting right now. And here's what we're going to do with our policy. We really only know when we get the data in hindsight. So the interesting thing, if you look at the chart, the red dash line is the stock market, and you see, bear market, bull market aren't the same things as recessions and expansions. Are different terms for a reason. It's what is the stock market doing versus the economy. So what you'll see is typically the market sees these things coming, and you get the bear markets again. If it were perfect, it's not always completely coupled. Sometimes it can be a little disjointed, but the bear markets tend to precede when those actual recessions are happening, right? So you see that they work in concert, but the bear markets, technically the peak in the stock market happens before the peak in the economy, right? So just an interesting observation there.
Yeah.
Um,
So before you go off on that as well, you talked about GDP on the previous slide.
yeah,
Um, that GDP, um, the technical recession is usually two negative GDPs in a quarter. So if you get
right,
2 quarters of negative GDP, that's what really defines out the recession, and we don't know that
right,
until they come out with GDP.
correct,
So
correct.
that's why we like to watch it. That's why we like to present GDP and look at it all the time. And the last time we had two negative quarters of GDP was in 2020. I
COVID,
think
yeah, right,
I
yeah.
think actually coming into 2022 we had a false reading of GDP. I think we had one negative quarter and one slightly negative, if not just a zero quarter.
I think it
Uh,
was, I think it was revised.
Oh, it
Yeah,
was revised afterwards, right?
yeah,
It wasn't technically a recession at that point in time.
right, right. That's when they were fighting the inflation battle. Yeah. Um,
That's when they started the
right,
interest rate move.
right.
So let's jump into that next slide because yeah. So this is your same business cycle again. We go from an increasing business cycle into your peak, and then we go down to and through recession to your trough. And different things happen as we go through the peaks. So when we're talking about what's happening in the business cycle, when we're talking about what the Fed is doing at different times in the business cycle, you have different things that move in the market at different times. So Dan talked a little bit about the small cap and the emerging markets. So as we're going down that from peak to trough, you tend to have your large cap values tend to move better, and your small cap, as you're getting down into that trough, tends to move better than other stocks, large cap growth, things like that. Um, Individual areas like the healthcare, consumer staples, and utilities tend to play out better as you're in that phase three of the contraction. The beginning phase, when you're in the expansion section, your information technologies, your financials, your communications, which we saw that play out in 2022, 2023, as your top 10 stocks in the S&P 500, your Googles, your Facebooks, your Nvidias, things like that continued to grow. Um, and you saw a lot of that play out. Now we believe we're getting towards that top into that phase two section. We should be actually on that top, working our way down to the right and going towards phase three. So it's anytime we get in those different phases, we look at different areas of the market. In this case, right now, you're looking at energy and materials and financials. You heard over the last couple of days, some of the financial markets have done very well in the last quarter, and you'll continue to hear that through the rest of this quarter. But this really is the reason why we talk about the Federal Reserve all the time, because the Federal Reserve, you got to always watch the Fed. Whatever the Fed does, it has something to do with this business cycle. And whatever this business cycle does has something to do with what the market does on a regular basis.
Right. And I think it's important because you know, we've heard this a lot, and I think the rhetoric will get stepped up. But the soft landing, I mean, basically, they're telegraphing that they think we're somewhere up here. We don't know exactly where. It's been expansionary for quite some time, but they're basically trying to say, look, we don't want it to be like this. We want it to be something more like this. And then it can kind of come back, right? So that's what they're talking about with a soft landing is if they look at the data just right and they move interest rates and monetary policy around just right, the idea is that an economic cycle, a business cycle is just sort of like a law of nature. These things just happen. But if we engineer it appropriately, we're not going to have this hard landing where we get, we go down into this trough and that it looks like a really severe recession. So that's why it's very important. It's really, that's what they're talking about.
Right.
So ultimately, with that as sort of a backdrop, I mean, moving into what was some big news for this quarter was Federal Reserve cuts the target rate by 0.5%, 50 basis points at their September meeting. So we had talked about this for quite some time. And really, I guess, I don't know, what was it, Rick, up until like the week of the meeting, really. The expectation was that they were going to cut the target rate by
25 basis points.
Yep. Yeah, 25 basis points. So, this, I don't want to say this was unexpected because it kind of came to light the week of, and this is what they ended up doing was a 50 basis point cut. But it certainly was larger than expected. And it may not seem like a big difference. We're saying, well, okay, 0.5%, 0.25%, we're talking about the same thing here, right? And I think certainly just, as an investor, as a consumer, if we said, well, your return was 5.25% versus 5.5%, right? We're talking, okay, we're right in that ballpark. But as far as the Federal Reserve goes, this is actually kind of a big deal because they are very, they get down to the brass tacks when they do these types of moves. So, I think one of the things, I mean, personally, that my reaction to this, and Rick, maybe yours is a bit different, but my reaction to this was, oh, they're cutting by 50 basis points instead of 25. What are they seeing in the data? And is it bad, right? Because we may think that, oh, this is a good thing. Rates are coming down. It'll create more growth. But I certainly looked at this and said, this may not be good. What are they seeing that they don't like? And the last time they did this was right before 2008 that they cut by 50 basis points.
Yeah, that's the last time they did it. So it's well over 10 years, well over 15 years ago. Right. I think, Dan, what they did is there's a couple things that they're really focused on. Labor is one of them. And you'll talk about a little bit about this as we move on. Wait a minute, what's going on? So you'll talk a little bit about this as we're moving on. The other piece to the puzzle is CPI and PCE. So, or CPE is personal consumption, PCE. And the PCE is probably one of the Fed's favorites as far as compared to CPI and PCE. Because that's basically where the Fed's focusing on once it turns its face from the employment over to personal consumption. I think your 25 basis points was because things are truly starting to slow down, and I think the other 25 basis points was political, little push from the back. So that's the Rick Bell thought process to that.
Yeah, it certainly may be, but I think there's an interesting thing here. So there's two pieces. You talked about PCE inflation. and really this is the Fed's dual mandate, right? It's full employment and inflation at 2%.
Yep.
So these charts are a little bit hard to understand, but ultimately these are just surveys of the Federal Reserve members, the committee members. What essentially ended up happening from June to September was in June, 4 months ago, when the Federal Reserve met, they saw above average risks to inflation, right? That in June, the focus was still the inflation war needs to be won. So what that looked like was of the 20 different members, 14 of them said there's above average risk to inflation. Fast forward to September, as of last month, that script completely flipped to there's now above average risks to the unemployment rate. And I believe, I don't have it here on the slides, I believe the unemployment rate is now hovering somewhere around 4.3%.
Yeah. Yeah.
Which is actually right around, it's a little bit above, but right around the long-term average. I think is right around 3.9 to 4%. So in absolute terms, it's certainly not concerning. I think the reason you're seeing that the Federal Reserve members are now saying, the majority of them are now saying there's above average risks to the unemployment rate, is because of the amount that the unemployment rate moved up. So we were around low 3% for quite some time. And all of a sudden you see a spike where it goes from 3.2% up to 4.3 within the matter of a single quarter. So I think they're concerned about the direction that unemployment is going, not necessarily the absolute rate of an unemployment, but if the trend continues and 4.3% becomes 4.8%, becomes 5.2%, then all of a sudden you have a labor market issue. And what exactly is it that's holding up the economy if now you have a labor market issue? And I think that that's part of why the Fed is moving moving the benchmark rate down a little bit faster, is they're saying, well, look, if the inflation issue has now become a labor market issue, we need to get ahead of this.
Right. And it's 4.1 as of September 2024.
4.1.
Yeah.
Okay, I was close.
You were very close.
I thought it was 4.3. And so basically on the tail of this, and we talked about, bonds had a very good quarter because of this move down. What is happening is the bond market is basically pricing in more aggressive rate cuts, and even more aggressive than what the Federal Reserve is targeting. So this is very technical, but essentially the red dots are all represent one member of the Federal Reserve Committee. And when you look at the charts that look like this, it gives you an idea of where these clusters are. That's a pretty good idea of where interest rate policy is going to be as of January 2025, January 2026, right? So what this is basically telling us is that the Fed is expecting to cut by another 50 basis points by the end of the year. That's what the Fed is expecting. Whether or not that will happen, we will see, but that's where they are here. And then by another, what's that, 1% or so by the end of next year. The interesting thing here, and this is where you really have to pay attention, is the market, which is represented by, and when we say the market, we're talking about interest rate futures. This green dotted line is below what the Federal Reserve is saying they're going to price it, they're actually going to cut in. Essentially, what this is saying is the bond market is pricing in the possibility that there's a recession coming. Now, this doesn't give us any indication of timing or severity. It's basically just saying interest rate futures are pricing in the fact that the Federal Reserve may have to actually cut rates even more than what they're saying, which why do you cut rates? To stifle growth. And that goes back to that business cycle. So if you're in that recessionary trough, you need to cut rates in order to create expansion again. If the Fed has their druthers, they're getting ahead of this now so that that trough part of the cycle is mild. And it looks to me like the bond market seems to agree with that thesis.
Yeah. The Rick Bell theory of economics is that the Fed's not going to do anything. They're going to be patient over the rest of this year. But who knows? I thought they were going to cut by 25 basis points and they cut by 50. And
I personally, I think it just depends what happens with the next unemployment reading.
yep.
You know, that they are so data dependent. And if that 4.1 becomes 4.5,
oh yeah, they're going to start chopping.
They're going to start chopping.
Yeah. Now, Dan, you've had this dot plot up on a couple of our other previous quarterly conversations. This dot plot tends to move quite a bit, so it's not as predictable as this looks. As things change in the market, these dots tend to change as well because the Federal Reserve changes their mind and they'll reset the dot plot.
That's all it is. It's one vote per person. So what they vote next time they meet could be completely different. It's basically what this chart is showing you is, let's put it this way. Here's what the experts think, the policymakers think. And here's what the market thinks.
Yep.
They're generally aligned, right? The experts in the market generally think rates are going to be moving down. And ultimately the reason this is important, of course, is it tells us a lot about where we are in that economic cycle. It should tell us a lot about what to expect in the markets. But I mean, practically, it also should tell us just where do we think interest rates are going, right? And I think that's the one interesting piece here, is that let's put it this way, unlike 2008, where you had a similar story in terms of, rates started cutting prior to a recession, and it ended up that, it ended up being a bad recession, this is typical, bad recession because there was a real estate crisis. One of the things that we actually think could be different if you compare it to 2008 is that the real estate market right now looks incredibly healthy, and there's a lot of demand out there that, again, if the Fed does this correctly and reduces rates at the right times, a lot of demand that will be sort of unlocked, if you will, as rates move down. Now, these rate movements do not bleed into mortgage markets perfectly. It's not like the Fed cut rates by 50 basis points. Oh, a 30-year mortgage is now 50 basis points left. It's not direct. It has that effect, but ultimately, and this is not I did not put this where it says magic mortgage rate, but ultimately, if you look at it this way, today's mortgage rate is at approximately on the 30-year 6.2%. And this is based on a survey done by this research firm, but approximately 21% of buyers are saying, I'm going to buy at current rates. There's a big jump when you get below 5.5%, 5%, where now you're at somewhere around half of the buyers in today's market are now actually going to look to buy, right? So the real estate market is still fairly hot and values are still elevated, and ultimately there's still a shortage of inventory to meet demand.
All right. Yeah.
Now, if the Fed does this appropriately, and if unemployment does continue to be an issue, and the Fed sees it as a potential problem that could cause a recession, and rates start to move down, I mean, as far as a soft landing goes, the real estate sector may actually be the saving grace because there is still so much pent up demand and a shortage of inventory that, a 1%, 1.5% change to the 30-year mortgage rate could unlock a ton of demand that's still out there. So I think that this is certainly an interesting piece where, we're not going back to the days of the 2.5% mortgage. I think they're gone.
Well, the last time we were at 2.5%, prior to most recent was 19. So I think in our lifetime it won't be around.
Right. But I do think that, when we see a 50 basis point move and, the Fed is telegraphing, well, we're going to move down by another 100 or so over the next year, that if we get into that sort of contractionary environment, that real estate may actually be the thing that keeps the economy propped up if the Fed can be surgical enough with their rate cut timing, that the real estate sector continues to be able to deliver. So I think that's the one thing sort of a bright spot this time around is the real estate market.
Yeah, and I think you're going to touch on this in the next slide a little bit, but when the Fed cut the rate,
Mhm.
interest rates did drop at that point in time. I think the lowest, they were at the lowest September 11th, believe it or not. Um,
Right.
and since then, the interest rates for mortgage rates have climbed. Not because it's the economy is off, but it's more specifically because that yield curve is
Yeah.
now starting to come back into shape again. We've been in an inverted yield curve predominantly for around 3 years at this point in time, or close to
Right.
3 years, and that's very unusual. We're not Your yield curve doesn't isn't inverted for 3 years, not typically. So
Right.
here you go. Yeah, that is the next slide. Go ahead.
Yeah, and so this is not perfect with mortgage rates, but it has something to do with, mortgage rates have more to do with like the 10-year
Yeah.
than what the Fed is doing with the benchmark rate. But um what this is, and this is no surprise, everybody, we've talked about this a lot. You're getting more on a 12-month CD or treasury than you are on a 10-year or a 20-year, which of course, how does that make any sense? That you get a higher yield for a 12-month than a 10-year. Um, this is starting to come back into shape. We do think that those intermediate, longer term, 7, 10, 20 years, they're going to be what you would call range bound, meaning they'll likely continue to be in this sort of tight window of yields. It's actually quite possible that they may even move up a bit, as the yield curve comes back into shape. But that ultimately what this means is we don't expect to see a lot of movement. Where we do expect to see a lot of movement as rates reduce is on this shorter end, right? Everything, I don't know, call it 2 years and less, where you see this is sort of just completely backwards. We would expect yields to move down. So, one thing to take away from this is that perhaps those mortgage rates don't move down as quickly as the Fed may like to
Yeah.
stifle growth. Another thing to take away from this, just purely from an investment perspective, is that the sort of the short-term, higher yielding treasury ladders that we've been utilizing for really the better part of the last 3 to 4 years, since rates started moving up, that, at least for now, even though rates are starting to move down, at least for now, that trade still appears to be alive and well. We do think that a barbell approach is warranted, where you don't want everything short term. That those sort of intermediate term bonds are looking more attractive than they did 3 years ago. But at the same time, you don't want to pile everything back into the other part of the yield curve because, again, these short-term bonds, while we can get it, we may as well get that 4.5 to 5% in yield while we can.
Yeah. And as that starts to come due, and as you start seeing indications that the Fed's going to continue to reduce rates,
Yeah.
that's when we start pushing those shorter term bonds that are coming due out the yield curve a little bit more out to the 10-year. That 10-year right now is a little over 4%. We did in October of 2023, we hit tad over 5. I think it was one day. That 10-year went over to 5, and then again in April it went to 4.7. And the 10-year doesn't really stick around that 4.7, 4 to 5% long. It tends to, if we can get into that rate
Yeah.
level of 4.5 to close to 5, I think we push out on the yield curve at that point in time. But I think it'll be opportunity, but that doesn't mean that it can't go higher. But as
Yeah.
that shorter term starts to come down, that 10, 20, and 30 year will start to push up a little bit as things start to normalize, which they
Yeah. I
have
think
not been
that
normal for a while.
the big thing is as long as we see this delta between what a normal range should be, which is really the two blue bars, as long as we see this big difference in short term, it's still worth it to be short.
Yeah,
and
yeah,
and that even though rates are moving down, we still have yet to see that difference is again still exists. So it's more likely that with these large Fed rate cuts that the money market accounts, the high yield savings accounts, we're going to see those move back down into this territory more aggressively. Whereas over here, longer, you might see some reductions, some increases. It'll start kind of shaping out a little bit better. But the large shifts are more likely to be on the short end, which makes sense based on the difference here. I think that was mostly what we wanted to talk about there. So just bringing it back a little bit to stocks, and the market. I mean, we've been talking about this for a while, and it finally this whole thesis proved itself out in the third quarter. So we kept calling it the broadening out of returns,
hmm
which essentially meant the top, whatever, the Magnificent Seven or the top 5 or the top 10, whatever you wanted to slice it, like you talked about, right? The Google, the Nvidia, Apple, Meta, they were driving all the returns. And we said it's only a matter of time. Valuations are stretched in those names. Every other name, S&P 490 is flat. If this isn't a bubble, these returns are going to broaden out to the rest of the market. And we've certainly seen that. And it really happened in the third quarter. So there was a rotation where small caps down here, value, and even international in the third quarter all outperformed the US large cap counterparts. And in an even larger sense, the NASDAQ, the tech heavy part, really didn't have much of a return at all. So you compare the NASDAQ in the third quarter 2.8% versus, for example, value stocks up almost 10% in the quarter. Right. So ultimately, this is kind of what we had been waiting for, this rotation. I don't know if I would say out of the growth stocks, but the rotation away from the growth in the tech stocks being favored to broadening out to those different sectors. And it appears that, if we go back to those business cycles, that it's fairly likely these trends will continue as, again, typically those types of names don't fare as well when you've reached peak economic cycle.
Yeah, and you identified that earlier when you highlighted that top part of the peak of the business cycle. So where value and small caps tend to start doing better, and growth stocks kind of fizzled out a bit.
Right, right. So we're starting to see the tide turn a little bit, based on what we talked about previously, and it I would expect that this trend will likely continue, perhaps not to this magnitude. I don't think we're going to see large dispersions, but it looks like the rotation has started. Oh, okay. Well, we waited long enough. It's 4:40, so
Here we go.
we got some time left here, and of course, presidential election year. So this is we pulled going way back. This is the Dow, so this is going way back 120 years. So 1900, all the elections going back to 1900. Now we are obviously,
And this is the last time we're going to talk about this for a while.
yeah, well, of course, because we'll be out of the election year.
Yes, sir. I can't wait.
So market is typically up most years. We're almost 10 months through the year at this point. So, and obviously market is up thus far this year. The dark line in the middle is just all elections in general, which you can see generally in an election year, the market is up. So your starting point right here at 100, generally you're up here. So regardless of party, and we'll talk a little bit about that as well in the next slide. Generally, in election year, the market is up. That's the general trend. What this is showing you, typically the trend that seems to hold true, whether it's a Democrat or a Republican, is whether or not the incumbent party, not candidate, whether or not the incumbent party wins or loses. Okay. And you can see that there's a difference in magnitude, but ultimately the dotted lines are the incumbent party losing. Incumbent party losing, Democrat here, Republican here, both are negative. Incumbent party winning, Democrat here, Republican here, both are positive. So obviously we're talking about 120 years of election cycles. I think it's this is like 30 some elections, going back 30 some elections. Not like it's always the case, the averages. So you think we're 10 years, 10 months through a year, market's up 20 some percent. So one of two things you would expect to happen is, incumbent party. So incumbent party wins. Typically that means the market is up, right? So incumbent party wins, it's likely the market would, stay up, or at least, retain a lot of the gains that we've seen this year. Incumbent party loses, market is typically negative. So you would expect to see some sort of correction happening, whether or not it has anything to do with the actual election timing. You would expect to see a correction at some point if the incumbent party loses. Now, of course, we don't know what's going to happen in November. And we don't know what the timing of these things would be. And of course, these are not hard and fast rules, but typically that's what happens.
And in 2016, the incumbent party didn't win. And the market had gone up. And again, in 2020, the incumbent party didn't win and the market has gone up. So that, this can be wrong in certain times, but this is statistics from way back. And, a lot of it has to do with policy. And I think both are taking on very similar policy. As once whoever gets in. And I think that's going to really drive. I think the big piece here, and I've read this a while back, is if it's a landslide, one side or the other, it doesn't matter. It could be problems for the market on the landslide. The market likes uncertainty, and as long as you have a balanced house, you have uncertainty.
Right. Well, that's true. Yeah, that is true too. So, you know, this is, I don't know if I would say what we talked about this last quarter. A
Hmm.
lot of times when the market is up in the 3 months, it's the 3 months leading up to the election. When the market is up, typically incumbent wins. When the market is down, typically incumbent loses. Um, right. So, and we talked about it. When I say market, I'm talking about S&P 500. If we're trying to look back at the last 3 months, the last quarter was up, but when we talk market, it's however you want to define it, but it's low single digits. So the what that tells me is the market is kind of uncertain. If you're going to use the market as a gauge of what's going to happen next and say, well, whatever happens the 3 months leading up to, which we're in that 3 months leading up to, a lot of the wind in the sails that happened in the first 6, 7 months of the year has come out of the sails. And to me, a lot of that says the market doesn't know what's going to happen.
Yeah.
Right. So anyway, just for what it's worth. Um, all of that is to say it doesn't matter. It really doesn't matter. I mean, look, it does. Rick just mentioned whoever ends up getting into office, the policies that are put in place, what they're saying now versus what they actually are able to do, and how that ends up bleeding into the markets and the economy. And does it cause inflation? Does it, uh, 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 that's a question for how is that going to affect us probably, you know, come 2026. It's going to take a little bit of time to actually bleed into the markets, to bleed into, um, you know, uh, uh, bleed into economic data, things of that nature. The reality is, from an investment perspective, we bring this up a lot. Probably sounds like a broken record, but it really doesn't matter which party is in power. The market tends to just go up. And there's really not a ton of correlation you can draw from here. There's recessions under Democratic presidents, there's recessions under Republican presidents, but the general trend is always up. And ultimately, we really don't think there's a lot to glean from the election cycle, and along party lines from an investment perspective. I think it really comes down to specific candidates, specific policies, and these things take quite a while to actually bleed into the markets and the economy.
Yeah. Yeah. And you said it earlier, Dan, it's yeah, there will always be expansions. There will
Yeah,
always be peaks. There will always be recessions, and there will always be troughs. That's a needed process in a business cycle, because when businesses get too aggressive, when things start moving aggressive, they start hiring like crazy. And then that recession happening gives those businesses a time to become more efficient, because they lose their efficiency as things grow quickly, and they get an opportunity to become more efficient when things start to slow down a bit. Um, and when you're talking policy, like the rhetoric you hear on the outside, it doesn't matter the party on the left or the party on the right. When they talk tariffs, there was tariffs that Trump put into place prior to going out of office with the Chinese, and those tariffs remained in place. Those policies remained in place to this day.
right,
Trump talked about manufacturing and adding more manufacturing. And the Inflation Reduction Act that we had during the Democratic Party was technically, it was more inflation. They call it a Reduction Act, but really what they did is they put a lot of funding in the CHIP Act. And what that does is that pulls manufacturing back into the United States.
right,
And so those tariffs are created to ultimately play a role in bringing competitiveness between countries, because China can undercut us on their steel. Take a look at Pittsburgh Steel, U.S. Steel out in Pittsburgh. The Japanese are trying to buy U.S. steel. U.S. doesn't want to let go of U.S. steel because it's the last steel manufacturing company in the country, and and we want to keep those jobs here. We don't want to get rid of those jobs. The more manufacturing style jobs we can put into place, it raises up a lower income economy and gives them higher end jobs to make more money to be able to keep this economy rolling. And that's the type of policies that are getting put into place, and it doesn't matter whether it's Republican or Democrat, they're putting them into place. There's a lot of other rhetoric going on besides that, but economically speaking, those are the opportunities that are helping this economy grow,
Right.
and it doesn't necessarily happen right away.
Right, right. Yeah, and I think, it's interesting you bring up the chips manufacturing and jobs. Trump is campaigning more on we're going to bring more manufacturing back to the US, and which is interesting because even though, and not to say this isn't the Harris administration, it's the Biden administration, but she's been in office, a lot of those jobs that are created by the chips manufacturing, she's just not really campaigning on that, right? So it's a similar outcome. You're bringing manufacturing jobs. You end up kind of in a similar place. Trump is looking to bring tariffs. Harris is looking to do down payment assistance on homes, both inflationary. It's just a different way of getting there. And so they're campaigning on different strategies, but ultimately, when you kind of read through some of the policies, it happens in different ways, but both candidates seem to have inflationary policies. And which is why I said I don't know if I think the war on inflation, maybe it's not over, but it's at least temporarily at bay. And we'll see who gets into office and who actually gets these policies pushed through and what they actually look like coming out the other side. But most of the actual rhetoric, to your point, it's coming from different angles, but it's inflationary.
Yeah, it's all inflationary.
Right.
That's why Dan, you and I talk about this all the time, is we don't see long-term um, low interest rates. We see an
Correct.
inflationary
Correct.
environment, and
Yes.
it's not necessarily going to be an aggressive inflationary environment. And inflation is not bad either. Inflation
No.
is
Right.
economic growth.
I
It's
was going to
just
say, and it's the necessary byproduct of if you have a trough and you start to get into this expansionary phase, inflation comes with that. So it's not surprising that both candidates are trying to get ahead of that because I think they understand where we are in the cycle. And I think, even though probably most Americans and most voters don't think of things in terms of where are we in the economic cycle, there's an intuition, there's a sense of that. So these I think these points resonate with voters, but I think that ultimately, from an investment and market perspective, we have to look at it and say, well, take the parties out of it. At the end of the day, we're getting inflation. It's going to happen again. Rates are going to reduce. You're going to get into a more contractionary period, and inflation is going to likely come back. It just depends who's in office and what the policies are, but it's very likely it'll come back, and it's very
yeah,
likely that rates, even though they'll probably come down because you have to do that to kind of rekindle the fire, so to speak. I don't know if they're going to be down for long. And we'll have to see, but I don't know if they're going to be down for long. I think they're going to come down, they're going to hold, and once inflation starts to rear its ugly head again, if the real estate market holds up, if especially I would say if the real estate market holds up, I don't think rates are gonna remain down for too long.
yeah,
So,
yeah. I
but
agree
anyway,
with that. We talk about that constantly. So Dan and I debate back and forth on every call we have, and we have multiple calls throughout the week. And
right.
as different articles pop out, as different things come out, we debate about all these things. But our heads are in the same place. We believe inflation's here to stay. We don't believe it's going to be aggressive inflation, but we do believe it's going to be long-term inflation. And we manage the portfolios consistent to that process. We don't time the portfolios, as many of you know that we do not time the portfolios. We want to stay fully invested at all times. We use a different types of portfolio, different types of investments within the portfolio between ETFs, trying to get that broader market, and actively manage mutual funds so they can direct where we're going in that business cycle, to be in that healthcare area, to be in the financials area as we continue to move through that business cycle. And then we ourselves put our own inflation hedge in there by utilizing dividend value. And the focus on that dividend value is just not to, it's there to protect the portfolio on downside, but ultimately as those dividends continue to grow, we keep up with inflation. If you're in a 5% bond and then all of a sudden that bond comes due and now you go into a 4% bond, but we still have inflation, your income's not there. So you have to add those pieces into the puzzle to cover that long-term growth. And that's why we manage the way we do.
Yeah, so I just we got a couple minutes here. We can certainly end this, but just if anybody has any questions or comments or thoughts, if you can use the chat box or the Q&A box to pop them in as we're wrapping up here, whether it's on, what the Fed is doing or how we're reacting to these things, what we're doing in portfolios, or you just want to share what the weather is wherever you are today.
We're not going to talk about bike riding though.
Okay. But yeah, I appreciate everybody joining us today. It's always great to do these things. If for some reason you can't join one in the future, we always record them. We put them up on our YouTube page. We send the links out in emails. And yeah, if there's anything you want to talk about, just send us a note. We're happy to jump on a call.
And we can always include comments that if you guys, if anybody has things that they want to hear more about, get deeper in, we can always add that to the quarterly conversations.
Right.
So Dan, I want to thank you for putting all this together. And for many of you, Dan writes our newsletter that goes out with the reports, and he actually pulls a lot of this together from the newsletter to be able to explain a little bit deeper.
Different format. So, sometimes a little better when we talk through it and show the pictures. So do we have? Nope, I didn't see anything pop. All right. Thank you everybody for joining us today. We look forward to the next quarter. We look forward to a great year end, and we will see everybody on the other side of the new year. Yep. Thanks, everyone.